Hey, happy holidays. I know this is a busy time of the year for most med spa owners. It's busy time for me, but I wanted to share with you what I'm doing with my clients to make sure they're paying the absolute minimum amount of taxes they have to legally at this time of the year. And I want to share my number one tax planning strategy at this time of the year, which is called the 12-month rule. The 12-month rule effectively allows you to prepay expenses, and I've got a little chart, that you would have paid next year in the current year. So effectively, you're shifting expenses from next year to the current year. So for example, the 12-month rule would allow you to prepay 12 months of rent in December and deduct it on this year's tax return. So that'd be $36,000 of deductions taken from next year's tax return and put it on this year's tax return. You can do the same thing by postponing income, but for most med spas, that are on credit card, non-insurance based, that's not really an issue. So I want to just talk about the expenses today. So why would you do that? I mean, it seems like just a shell game, right? You're moving it from one side to the other. Well, why you do that is to reduce your income level low enough to qualify for certain credits. I've got a couple of the credits here I'll just talk about. Well, what credits or deductions are allowed for are driven by income level? Well, the qualified big business income deduction is driven by income level, capped out at $340,000 of income. If you're above that, you don't qualify. Just game's over. College education credits, $160,000 of income. Now, this I'm talking about for a married couple, but those are $2,500 each for the American Opportunity Credit. Healthcare premium credit, that's based on the family, the size, but tax credit, the child tax credit, the employee tax credit, whether you can contribute to a Roth or not. Whether you can contribute to an IRA tax deductible. So the tax code is full of credits that are driven by how much you make. And the idea with using the 12-month rule is to know where you're at year end and make sure that you're not just over the threshold. What you want to do is make sure you draw your income below the threshold so that you qualify. About 2 years ago, I had a new client come in. I was able to get their accounting records up to date before year end. And they were about, I think it was about $180,000. They had a large family, 5 kids, 2 in college. We were able to reduce their income down below $160,000 legally by using the 12-month rule to have them qualify for 2 kids that were in college, American Opportunity Credits, that was $5,000, and also to optimize their premium healthcare credit. They were on the market exchange for healthcare, and that saved them about $10,000. So that was $15,000 in tax savings just by using that 12-month rule to say where you're at. So some people come in and they say, next year I'm going to add a laser. Well, I got too many expenses next year already. I can write off the whole laser. So you wouldn't want to necessarily have more expenses. Why not prepay your rent this year and smooth out your income level, or at least reduce your high income level this year? And then let's say you're expanding, right? Another opportunity, you're doing leasehold improvements, possibly buying a building, possibly adding staff. Not going to be a high profit year next year. Well, take some of those expenses. So what type of expenses qualify? Certainly rent does. Certainly office supplies do. Certainly insurance premiums qualify. If you have lease payments on equipment or lease payments on a car that's owned by the business, those are all things that you can prepay up to 12 months of premiums in advance and deduct now. So one of the sticky issues is with inventory. Historically, before 2017, with the Tax Cut and Jobs Act, inventory was one of those things you bought and you only wrote off when it was utilized, right? When you delivered services. In 2017, the game changed. Now that's kind of working its way through IRS guidance and regulations as far as what exactly do they mean. Can we write off inventory in the year we buy it? I'm going to do another video on this, but think about that. For a lot of med spas, a third of their costs are in inventory. And if you plan things right, you have the opportunity to, buy $50,000, $100,000 at year end and accelerate expenses and write it off in the current year. So it's a huge planning opportunity, but it's not something I can cover completely in this video. But I want you to think about the 12-month rule. And also, I want to just point out, none of this planning is possible without having your accounting records up to date, without having a profit and tax forecast done so that you can do year-end tax planning. Right? So this is kind of my hierarchy of this is step one, step two. You don't get to the top of the pyramid, which is year-round tax planning, without having some of these things in place, So when people come in and they're like, my books are 6 months behind, I can't do a profit and tax forecast for them. Or, their tax preparer is never talking to them in quarter four to do this type of calculation. If you have a bookkeeper and then you meet with your tax planner or your preparer after year end, you're not going to be able to use a 12-month rule. One other thing, let's say you're tight on cash. If you're you can use a credit card, and the IRS will let you use the 12-month rule. Put it on your credit card in December, and whether it's your rent, whether it's your office supplies, I don't know what else you could put on your credit card, but the point is you don't necessarily have to pay for it with cash if you're a sole proprietor or an LLC acting as a disregarded entity, which is the same thing as a sole prop. If you're an LLC acting as a partnership, that works too. If you're an S corporation, the card has to be in the corporation's name. If it's in your name, you can't use the credit card and ramp that up with the December charges and take them on the current year tax year. That's it. My time's out. Have a happy holiday season. I hope it's really productive for you. And thanks again for being part of the group, and thanks for your time.